Welcome to this explainer. We hear about the Reserve Bank of India making these massive macroeconomic decisions, and honestly, it usually sounds like a bunch of high-level financial jargon, right? But the truth is, what they decide is literally the steering wheel for your personal wealth. So today, we're cutting through the noise. We're going to break down exactly what the latest RBI news actually means for your wallet, your loans, and your savings.
Okay, so here's the big question. The RBI just kept interest rates completely unchanged. But why should you care? Especially if you don't actively follow the stock market or, trade bonds. There's this super common misconception that central bank policy is really only for Wall Street traders or economists in suits. But the reality? It's way more personal than that. Because even if you have never looked at a single stock chart in your life, the RBI's decisions directly dictate the cost of your next car, the interest on your home loan, and even how fast your savings are going to grow in the bank.
So the absolutely crucial detail here is this number, 5.25%. The RBI's Monetary Policy Committee met recently, and they unanimously decided to just keep the repo rate exactly where it is, stuck at 5.25% for yet another consecutive meeting. They also kept what they call a neutral stance. Basically, that just means they aren't rushing to hike rates up anytime soon, but they definitely aren't dropping them down either. It's a holding pattern, a very deliberate pause. But to really understand why they hit the pause button, we've got to look at the data driving that choice. And that brings us to 4.45%, which was India's retail inflation rate for July. See, the RBI has a strict mandate. They have to keep inflation hovering around 4%. But in July, inflation edged up past that target, and that was largely driven by some really stubborn food and fuel costs. Interestingly enough, inflation was actually higher in rural areas, hitting 4.84% compared to urban areas. So because the RBI is looking at these price pressures, plus global uncertainties like oil prices and the impact of El Nino on the monsoons, they basically decided, nope, it's just too early to start cutting rates. They're playing it safe.
Now, let's simplify this whole thing. What exactly is the repo rate? Honestly, just think of it as the wholesale cost of money. It's like a supermarket. A supermarket buys apples at a wholesale price and then sells them to you at a higher retail price, right? Commercial banks do the exact same thing. They borrow money from the RBI at the wholesale rate, which is the repo rate, and then they lend it to you at a retail rate. So when that wholesale cost stays flat at 5.25%, the retail cost of your loans and the returns on your deposits, they aren't dropping either. The cost of money is staying elevated.
And this brilliantly illustrates a real-world divide. A stable repo rate creates this sort of dual reality, depending entirely on which side of the financial fence you're sitting on. If you're a borrower, this means the EMIs on your floating rate home loans or personal loans are going to stay elevated for a while longer. To put that into perspective, if you have a 50 lakh rupee home loan taken at 9%, you are still shelling out over 40,000 rupees a month, and there's no immediate relief coming. But if you're a saver, this is actually fantastic news. Fixed deposits and savings accounts are going to continue offering really attractive, strong returns simply because banks still need to attract your money in this high-rate environment.
Now, there's a really fascinating dynamic at play here, and it's called the concept of transmission. We often have this idea that the exact second the RBI governor speaks on TV, our bank accounts instantly update. Well, that's an illusion. Policy rate pauses or even cuts, when they do eventually happen, they don't just magically freeze or shift your bank account overnight. Banks actually take time to pass these changes on to consumers. So if you're a borrower who's been desperately waiting for your EMI to drop, it's absolutely crucial to manage your expectations. It's a gradual process, not just a sudden flip of a switch. To really ground this abstract central bank policy into everyday life, let's look at a real-world scenario. A young couple actually posted this exact question on Reddit recently. They asked, can we afford a 30 lakh rupee car with our current finances, or should we wait? I love this because it perfectly captures what we're talking about. When the cost of borrowing is stuck at a multi-year high, taking on big-ticket purchases, like a luxury vehicle, suddenly requires a lot more mathematical scrutiny than it used to. Let's break down their monthly profile because it's actually really impressive. They bring in a combined income of 3.5 lakh rupees. Right now, they're servicing a 68,000 rupee home loan EMI. But just look at their investment discipline. They're putting 1 lakh into mutual fund SIPs, plus another 62,000 into stocks, PPF, and NPS. All while keeping their living expenses very reasonable at around 50,000. So we're looking at a financially robust household here. But they want to drop 9 to 10 lakhs as a down payment and borrow the rest for this brand new car. So we hit the ultimate dilemma. Do they borrow now or do they wait? This is exactly where that 5.25% repo rate really starts to bite. Taking on a brand new 20 lakh rupee auto loan today locks them straight into a high interest rate cycle. Plus, pulling 10 lakhs out of their liquid savings for the down payment carries a massive opportunity cost, especially right now when fixed deposits and market investments are yielding such great returns. It's the classic trade-off, really, upgrading your current lifestyle versus stomaching the high cost of debt.
Now, if you do find yourself in a position where you absolutely must borrow right now, flexibility is going to be your best friend. For instance, with home loans, the RBI actually mandates zero foreclosure fees on floating interest rate loans. This is a massive piece of consumer protection. It basically means that if you take a floating rate loan today while rates are high, you're set up to benefit whenever rates eventually do fall. And say you get a bonus at work or a lump sum of cash, you can prepay that loan without getting hit by any sneaky penalty fees from your bank.
All right, let's pivot over to your investments. Look, a single RBI policy pause should absolutely never cause you to panic buy or panic sell. Building long-term wealth, it isn't about guessing what the central bank is going to do next month. It's all about consistency. The steps are super simple. Focus on your long-term goals, respect the time horizon of your investments, and just maintain a disciplined asset allocation. Think back to that Reddit couple we just looked at. Their superpower isn't timing the market. Their superpower is that they consistently invest over 1.6 lakhs every single month, totally regardless of what the repo rate is doing. And honestly, this brings us to the biggest lesson of all here, the dichotomy of control. There are things that are just completely outside of your control. Global oil prices, geopolitical tensions, weather patterns like El Nino, and yes, the RBI repo rate. We really need to stop stressing over these macroeconomic headwinds. Instead, we've got to focus entirely on what is actually in our control: your personal debt levels, your monthly savings rate, and the health of your emergency fund. Optimizing your own personal balance sheet is literally the best defense you can have against any economic environment. This exact philosophy, focusing strictly on what you can control, well, that's the entire foundation of NitiVitt. NitiVitt is an intelligent financial guidance platform designed specifically for the Indian market. It was built because, let's face it, we have more financial products available today than ever before, but somehow we just have more confusion than ever, too. NitiVitt isn't here to push you to trade or sell you products for some commission. It's designed purely to diagnose your financial health and turn all this knowledge into actual rock-solid financial confidence. Now, what's really cool is how the NitiVitt system actually works behind the scenes without overcomplicating things for you. First off, there's the NitiScore. This evaluates your overall financial resilience on a scale of 0 to 1,000, and it doesn't just look at how much wealth you have, it looks at the actual quality of your financial habits. Then there's NitiPath. Instead of overwhelming you with a list of a dozen things you need to fix, NitiPath uses clear, deterministic math to identify the single highest priority action you need to take right now to improve your score. It completely bridges that gap between knowing your financial health and actually taking meaningful action. So as we wrap up this explainer, I really want to leave you with a final thought. Don't just ask what the RBI is going to do next. You should be asking what your own financial position looks like if rates end up staying higher for longer. Really ask yourself, would you rather have lower EMIs, higher FD returns, or neither if it ultimately meant a stronger, more stable economy for your long-term investments? It's all a question of perspective, and I highly encourage you to look at your own financial context to find that answer. Thanks so much for joining me for this explainer, and hey, keep building that financial resilience.